For enterprise organizations, managing all your food needs is a tall order. But with Easy Cater, you get a single workplace food vendor with the tools and resources to make it easy, giving teams across your organization an easy way to order from a huge variety of restaurants, all on one platform. All while consolidating your corporate food spend so you can control costs, streamline billing and payment, and simplify reporting. Easy Cater, your business tool for food. To learn more, visit easycater.com/podcast.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/STORIES.
This is what the market used to sound like. Pretty complex. But today, with iShares by BlackRock, investing is easier. With over 450 ETFs, iShares gives you easy access to countless market opportunities. iShares by BlackRock. The market is yours. Visit www.ishares.com to view a prospectus, which includes investment objectives, risks, fees, expenses, and other information that you should read and consider carefully before investing. Risk includes principal loss. Prepared by BlackRock Investments, LLC, member FINRA.
Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, earnings from some of the U.S.'s biggest retailers and what impact they may already be seeing from the Trump tariffs. I'm Tom Busby in New York.
I'm Stephen Carroll in London, where we're looking at the challenges facing European banking consolidation ahead of an upcoming shareholder vote in Italy.
I'm Doug Krisner with a look at what we can expect from a slew of Japanese economic data in the week ahead.
That's all straight ahead on Bloomberg Daybreak Weekend. On Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 92.9 Boston, DAB Digital Radio London, Sirius XM 121, and around the world on BloombergRadio.com and the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with the slumping U.S. housing market. This week, though, some key data, including housing starts and existing home sales for July. Also, earnings from the nation's biggest home improvement chains and what those numbers could tell us about the housing market. And for more, we're joined by Drew Redding, Bloomberg Intelligence U.S. home building analyst. Drew, thank you so much for being with us. We know all the usual suspects, sky-high home prices, mortgage rates now just under 7% amid those challenges. Let's start with, what do you expect to see in the July housing starts number?
Yeah, you hit the nail on the head. We think that housing starts will come under further pressure. Through one half, we're down about 1% over last year. And the weakness has really come from the single family side. Single family starts are down about 7% year to date, while multifamily units are up 17%. Given what we've heard from the builders, we expect that we'll continue to see a pullback in single family production through the remainder of the year. Now, remember, the public builders account for roughly 50% of industry volumes. And what they've been telling us almost universally is that they're limiting their pace of starts as they look to match production with demand. So that's a big piece of the pie that we know is going to slow down in the coming months. If you look at the inventory levels in the new home market, we're at the highest since 2007. And a lot of that is under construction or completed inventory. So there's really no incentive for builders to keep adding new supply until they start to clear out some of that excess spec inventory.
And how are they going to clear that out? What incentives do they have for would-be buyers?
I think everybody understands at this point just how aggressive the builders have been in their use of sales incentives. What they use is going to depend on the buyer type. Typically, you'll see first-time or entry-level home buyers take the mortgage rate buy down. That's the predominant incentive out there in the market. But you do see, some buyers on the higher end will choose to take some type of, options in the design studio, maybe some structural options or help with a down payment or something like that. But primarily what we're seeing is the use of mortgage rate buy downs, and that's really what's eating into builders' margins right now. We've heard from a number of the builders during earnings saying that they expect that incentives aren't only going to remain the same, they think they're actually going to tick up a little bit higher in the second half of the year. So we'll see how that plays out with rates coming in a little bit over the last several weeks. But certainly incentives are the thing to watch out for in the second half for the builders.
Well, and are those the high prices and the elevated rates that are making home sales so difficult? Is it pushing more people at all income levels to rent instead of buy right now? Are they waiting it out?
Yeah, certainly, we've seen more demand on the rental side of the business. You have rents starting to moderate a little bit with some of the supply that's come into the market. We had some data come out recently on household formation, and it was driven exclusively by renter households. And as you mentioned, it's the rates and it's the prices that are pushing people out of home ownership. So, rates could come down a little bit. We think it'll help the marginal buyer, but home prices are still 50% higher than they were at the end of 2019. So we think you really need a combination of lower rates and maybe prices to come down a little bit, along with some income growth in order to get the housing market moving a little bit better.
And that goes for the existing home sales as well. Same thing, the elevated prices. But they are seeing a little more inventory come on the market, though, for existing homes, right?
Yeah, so we think with the inventory that's come on the market, we're up about 25% year over year, and now we're within somewhere around 10% of 2019 levels. We think that could help with volumes, but we think that it's going to come at the expense of prices. So home prices have already started to moderate on a year over year pace. And if you look at some of the biggest markets in the country, we're already down year over year in terms of prices. So we think that'll continue to play out where the existing home market will see some volume gains, but you're going to see prices come down a little bit.
The Fed's next policy meeting just a few weeks away. Wall Street pretty much expecting policymakers to lower their benchmark lending rate for the first time this year. But what would that mean for housing, and what would that mean for Home Depot and Lowe's, which report their latest earnings this coming week?
Yeah, good question. I mean, all you have to do is look at the builder stocks to see kind of some of the enthusiasm that's out there in terms of the potential for a Fed rate cut. What you have to remember is, though, that mortgage rates have probably largely already priced in any reduction by the Fed. So I wouldn't expect to see a significant leg lower in mortgage rates just from the Fed cut. Mortgage rates have come in over 50 basis points. We're at about 6.5% now compared to over 7 just back in the beginning of July. So we've certainly made some significant progress. In terms of what that means for the home improvement space in Home Depot and Lowe's, one of the big areas of concern has been the weakness in big ticket discretionary spending. So think of things like kitchens and bath remodels, flooring projects. These are things that typically tend to be financed. So with rates having been as high as they are, we've seen people put off those purchasing decisions. So we think just like it'll help home sales on the margin, I think you'll see a little bit more refinancing activity with rates in the mid to low 6% range, which could on the margin spur some of that big ticket spending. And when that does start to come back, we think that some of the investments Home Depot and Lowe's have made over the last couple of years, despite this market weakness, will really put them in a good position for growth.
Well, let's hope for good news. New home construction numbers for July out on Tuesday. Existing home sales for that same month on Thursday. Home Depot earnings on Tuesday, Lowe's on Wednesday. Our thanks to Drew Redding, Bloomberg Intelligence U.S. home building analyst. We move next to more corporate earnings coming this week from two of the nation's biggest retailers, Walmart and Target. With inflation still a worry, are Americans spending, and are they spending at those stores? And have those stores seen any impact so far from the Trump tariffs? For all that and more, we're joined by Jennifer Bartashis, Bloomberg Intelligence Senior Analyst, Retail Staples and Packaged Food. Well, Jen, thank you. And I want to start with actually some pretty good news that came out this past Friday from the Commerce Department. Retail sales advancing in July, helped by auto sales and all those Black Friday-like sales at Amazon, Walmart, Target, Best Buy, and others. Now, that is good news, isn't it? But what does it tell us about the consumer right now?
It's overall good news with regards to the consumers are willing to spend, but they're spending on those sales events. And so what that really underscores is that consumer value proposition is so important for these retailers. People are willing to spend, but they want deals. They want to see prices that they think are good prices. And so that's really the takeaway. And when you offer that compelling proposition, they are responding. And so there's a little bit of money out there. It's not necessarily going to help this current quarter of earnings, but it should help next quarter earnings for sure.
Well, let's talk about this quarter earnings, the second earnings. Walmart was a big winner of all that online spending. Also, still blowout grocery sales, double-digit growth in online sales. What are you expecting to see in its second quarter results?
What's interesting about Walmart is they have arguably the best visibility into your mainstream American consumer than any other retailer. They touch almost the entire population in the United States to some degree. And so what we're expecting to see is just another strong quarter for Walmart. That value proposition that I mentioned is something that drives people there. But Walmart has been really good about execution. And so they've been good about executing in terms of growing their marketplace, in terms of their offerings, improving the quality of their grocery, and continuing to grow market share there. So it's a combination of execution as well as the value proposition that they offer that really should drive some strong results with regards to top line growth and same store sales.
Now, aside from its food aisles, a lot of what is sold at Walmart is imported, a lot of that coming from China. What impact have the Trump tariffs had on Walmart so far, and can it manage to limit passing along those higher costs to shoppers, or is it coming and we know it's coming?
I think that there are going to be some costs that go up for consumers, but the advantage that Walmart has is that it is so big and its scale is so large that it can help minimize the amount that it does have to pass through to consumers. And they can be very selective on which products it hits. And so, when you're talking about especially general merchandise or things like apparel, that's where the tariffs come into much more play. But Walmart has that ability to negotiate with their suppliers. They've had a very active program for a long time in terms of purchasing manufactured in the USA goods in their home departments, for example, and things like that. So they've had long-term efforts in place to sort of mitigate where they're sourcing from. And in the recent year or two, they've really diversified the sourcing of where they're getting goods from. So that makes it a little bit easier for them to offset that impact. But inevitably, there will be some prices that have to go up, and that will ultimately impact consumers.
Well, let's talk about the other side of the coin, and that is Target, which has been struggling now for a couple of years. Sales growth stagnating. It's facing a boycott after scrapping DEI initiatives just last week. Bank of America downgraded the retailer. So what do you expect to see in its earnings report this week?
Very much like the first quarter, we're going to see a little bit more divergence between Target and Walmart. And Target simply has not yet gotten back to that cachet that it once had with its consumers and its core followers. Their digital sales are slowing. They have a different approach to a marketplace, which is much more limited in scale. And importantly, we're seeing that some of the partnerships that were supposed to help drive growth coming to an end. So the partnership that Walmart has with Ulta, for example, where they had Ulta stores within a Target store, is coming to an end. And both retailers are sort of going their separate ways. So, those are the kinds of things where, I think people are looking at Target and wondering, where is the future growth going to come from? They can compete to a certain degree on price, but they are much more exposed in terms of tariffs and other pressures because of the merchandise mix that they sell.
Our thanks to Jennifer Bartashis, Bloomberg Intelligence Senior Analyst, Retail Staples and Packaged Food. Coming up on Bloomberg Daybreak Weekend, we'll look at the challenges facing European banking consolidation plans. That's ahead of an upcoming shareholder vote in Italy. I'm Tom Busby, and this is Bloomberg.
How many vendors does it take to meet all your organization's food needs? Just one. EasyCater, the workplace food platform that lets teams order from a huge variety of restaurants, over 100,000 nationwide, all through a single vendor. In addition to all that variety, EasyCater also gives you full visibility of your organization's food spend with invoicing, centralized reporting, and seamless integration with expense management systems, all on one platform. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
So, Have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/STORIES.
These days, AI can help you write emails, summarize long meetings, and even create presentations that impress your most demanding customer. But how about industrial AI that uses data and simulation to boost productivity on the shop floor? AI tools that help you understand machine language. AI that helps you grow your business. With Siemens Accelerator, you can use AI services, software, and consulting from a single trusted digital business platform. Plus, you can find the right AI partner without having to search through hundreds of providers. That's AI for real, from the global market leader in industrial AI. Siemens Accelerator. Learn more at siemens.us/accelerator.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. Up later in our program, we'll look ahead to several key data points in Japan. But first, the countdown is on in Italy to a deadline in a potential takeover in the banking sector. Mediobanca's shareholders will vote on its bid to take over wealth manager Banca Generali. It's the latest in a string of potential deals which could consolidate Europe's banking sector. But some remain opposed to creating bigger financial institutions on the continent. For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Stephen Carroll.
Tom, Italy has been at the heart of a wave of attempted banking consolidation across Europe, and things are set to heat up in the coming weeks. Despite encouragement from the European Union, only a few of the potential deals are seeing real progress towards completion. Italy's Unicredit and Spain's BBVA have launched attempts to buy rivals, only to meet with sometimes bitter opposition from Berlin, Rome and Madrid. Mediobanca's CEO Alberto Nagel says national governments are standing in the way of creating bigger banks in the EU. His lender is facing an unsolicited takeover offer from rival Monte dei Paschi, which is supported by its largest shareholder, the Italian government. Nagel has repeatedly rejected the bid, which he calls totally inadequate, and has in turn mounted an acquisition effort for Banca Generali, the wealth management unit of the country's biggest insurer. It gives the Mediobanca CEO a unique perspective on this European-wide issue. Here's what he had to say about the situation when he spoke to Bloomberg earlier this month.
Well, we are, as I said, delivering or over-delivering on our strategy. Our strategy is a strategy where we are focusing more and more on wealth management and IB capital light. On top, we have also worked at Banca Generali transaction. So for our shareholder, according to our view, there is no match between Mediobanca standalone plus Banca Generali and the possibility to be part of a group.
How big is the probability that Monte Paschi actually gets Mediobanca at the end of the day?
Well, this is up to our shareholder. We are, as I said, recommended to look carefully at the content of Monte Paschi bid because financially it is a discount to our market value. As Monte Paschi is half of our market cap, this transaction is construed where basically our shareholder should get 60% of the combined entity but not pay the premium. So this is something that, honestly, a long-term shareholder of Mediobanca should not accept.
Mediobanca CEO Alberto Nagel there speaking to Bloomberg's Francine Lacqua earlier this month. So what does the future of the Italian lender look like? And more broadly, what does it tell us about the European banking landscape? To discuss, I'm joined by our senior finance reporter in Milan, Sonia Serletti, and by Bloomberg TV anchor Kriti Gupta, who's been following this story across the continent for us. Sonia, to you first, ahead of this shareholder meeting in the coming days for Mediobanca, what can you tell us about the offer that they're making for Banca Generali?
Yes, as you said before, Italy's banking sector is now at the center of this fresh wave of merger and acquisition activity that kicked off in early November. And at the center of the action now, there's Mediobanca, who's seeking investor approval to go ahead with the bid for Banca Generali to basically fend off hostile takeover from rival Banca Monte dei Paschi di Siena. Nagel, he's the CEO of Mediobanca, is proposing Banca Generali bid as alternative to Monte Paschi takeover offer. And on August 21, there is a key moment because investors of Mediobanca are called to decide whether to go ahead with this bid or they can reject the proposal in what would be a big blow for Nagel's strategy to preserve the bank's independence and secure his own future at the helm of the bank.
What are the expectations ahead of that vote?
The expectations are uncertain. The vote will be likely very tight. We have seen that Nagel has before postponed the meeting amid the sign that he wasn't able to get majority. I want to remember that Mediobanca needs the 50% plus one of voting in favor of the bid to go ahead. And then he has rescheduled the meeting after some shareholder changes happened. So maybe he thinks that he can get back. For sure, the situation is delicate, and if he will be able to win or lose the meeting is still uncertain. But what I want to say is that while the vote will be a big win or a big blow for Nagel's strategy, and Nagel attempts to fend off Monte Paschi bid, the final end game, the final battle will happen in September when Monte Paschi will close his offer on Mediobanca, and from this result, a lot of things can change, not only for Mediobanca but probably for the whole landscape of Italian banking.
And just to understand this, why is Nagel so keen to refuse the Monte Paschi offer?
Alberto Nagel, first of all, is the longest-standing CEO of Mediobanca, and he has emerged like as this central figure in resisting Monte Paschi's approach. I would say that his reluctance is rooted in a sort of combination of strategic and reputational factors. For Nagel, Mediobanca's legacy and independence is a core priority. He affirms that the core activities of the two banks are different, being Monte Paschi mainly a retail bank, while Mediobanca is focused on wealth and investment banking. Furthermore, there are questions around valuation and governance. Nagel and his board see the terms of Monte Paschi offer as underwhelming and potentially disruptive. So valuation is not reflecting the real value of the offer. And on the other side, there are issues about governance, according to Nagel. In Italy, nothing is simple, and all of this M&A saga is like an intricate chess game where there are cross-shareholdings, competing alliances, overlapping interests that mean that every move reverberates through the financial system. In particular, on this bid, what we see, Mediobanca's largest shareholders are billionaire tycoon Francesco Caltagirone and Del Vecchio families. They also have major stakes in Monte Paschi, who's doing a bid on Mediobanca, and Assicurazioni Generali, which sees Mediobanca as main shareholder too. So there are a lot of different interests, and Nagel is evoking a conflict of interest too. And so this is another matter of opposition. That said, the history shows that any hostile bid see the reluctance of the CEO of the target company in agreeing on the bid.
Yeah, I mean, it's an absolutely fascinating web of cross-shareholdings, as you described, Sonia. Let's zoom out a bit. I want to bring in Kriti Gupta, who's been listening into the conversation as well. I mean, Kriti, you've been across the banking story across Europe. Just talk to us about the motivation behind what's driving this wave of consolidation.
Well, it's a fascinating story because in some ways it's been in the works since the inception of the EU, frankly, and this idea that you want to have a coordinated bid, you want to build out a capital markets union, you want to bring out a banking union as well. And this kind of consolidation is seen as an intermediary step or even just a first step towards that ultimate goal. There's a couple of other factors here, though, in that Europe especially in recent years, has really been trying to get more competitive and take over market share internationally from some of the more U.S. kind of focused banks, but also some of the growing competition in Asia as well. So that's another piece of it. And the thinking there is you have to be stronger at home to be able to do that kind of business abroad. The third piece of this is kind of a little bit of a hangover when it comes to the experience a lot of European banks have had from COVID and also from the GFC and arguably the sovereign debt crisis as well. This idea that if you are already operating in different markets, so a hypothetical for UniCredit or for BBVA, where you're operating in your home country of Italy or Spain, but also have operations in, say, the UK or say in Germany or name your country, in times of recession, when the government needs to take active steps to protect the banking sector of that individual country, how easy is it for some of those banks that belong to a different home country to pull out those funds or to inject that kind of liquidity? And there have been concerns in those previous crises of who that loyalty kind of belongs to and whether being a European bank ultimately means that you are a Spanish or an Italian or a German bank first.
Talk to us about some of the other, we've reflected on some of the Italian moves there with Sonia, but talk to us about some of the other big deals that we're watching elsewhere in Europe. I know that BBVA and Sabadell is one that you've been particularly monitoring closely.
I'm fascinated by this story because I think it's such a crucial one. Consolidation on the surface seems like such a normal, natural thing to pursue, especially as you get larger and especially as some of these banking behemoths really pursue that kind of scale. I think what gets missed quite often in the argument that the likes of Banco Sabadell or arguably other takeover acquisition targets are making is simply this idea that the bigger you get, the harder it is to service, the local bakery that has a loan and that's been working with the local branch of, say, Sabadell for centuries or decades or whatever. And that's the concern that is ultimately showing up in a lot of these big banks that are under major pressure to build out their profitability, lean into digital banking. It also not only influences or kind of drives the question of how can they serve smaller clients, your local clients, but also how they can employ the people in certain regions. And that's really what has been a consistent sticking point in some of these consolidation conversations.
Talk to us about how this is playing out between national capitals in Europe and the European Union, because the EU, I mean, if you read the Draghi or the letter reports, banking consolidation, capital markets union, deeper capital markets, all things everyone seems really happy about until you get some of the national governments involved who say, we like the idea, but in this particular case, we don't think that it's appropriate for the market. How much of a tension is there between those two sides?
Oh my gosh, the tension couldn't be more tense, frankly. It's fascinating because it also goes back to this question of who is actually in charge of a European country. Is it the local government or is it the folks over in Brussels, for example? And this is something you see, a tenuous conversation you see in any industry, really. It's not just coming up in banking consolidation. You've seen it in things like foreign policy narratives. You've seen it in defense rearmament. You've seen it in kind of local investment in things like infrastructure. Whose burden is that to decide those policies? Not to mention regulation as well. Things like tech regulation have largely been driven out of Brussels, but there have been local conversations about that as well. From a banking standpoint, again, this is something where Brussels is thinking about Europe as a whole and how it can compete on the international stage as a whole. What it can, and the argument that a lot of local governments are making, especially as politics starts to drive the conversation, is are you thinking about the people employed in a certain region of a certain country that could be driving a national narrative or a national shift or a change in local regulation? And that's where the tension comes between what you're thinking of in Brussels versus Madrid or Rome or Paris.
Okay, Kriti Gupta, thank you very much for talking us through that, and to our senior finance reporter in Milan, Sonia Serletti, helping us to look ahead to that key shareholder meeting happening in the coming days. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Tom?
Thank you, Stephen. And coming up on Bloomberg Daybreak Weekend, we'll check in on the health of the Japanese economy with the release of several key data points. I'm Tom Busby, and this is Bloomberg.
For enterprise organizations, managing all your food needs is a tall order. But with EasyCater, you get a single workplace food vendor with the tools and resources to make it easy, giving teams across your organization an easy way to order from a huge variety of restaurants, all on one platform. all while consolidating your corporate food spend so you can control costs, streamline billing and payment, and simplify reporting. EasyCater, your business tool for food. To learn more, visit easycater.com/podcast.
So, have you heard the story about the prescription plan with savings automatically built in? It's where a family of any size can feel confident the cost of their medication won't hold them back. Go to cmk.co/stories to learn how CVS Caremark helps members save just by being members. That's cmk.co/STORIES.
These days, AI can help you write emails, summarize long meetings, and even create presentations that impress your most demanding customer. But how about industrial AI that uses data and simulation to boost productivity on the shop floor? AI tools that help you understand machine language. AI that helps you grow your business. With Siemens Accelerator, you can use AI services, software, and consulting from a single trusted digital business platform. Plus, you can find the right AI partner without having to search through hundreds of providers. That's AI for real, from the global market leader in industrial AI. Siemens Accelerator. Learn more at siemens.us/accelerator.
This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. I'm Tom Busby in New York. We turn next to Japan and the release this week of several key data points, including CPI, PMI surveys, and trade figures. Bloomberg's Doug Krisner checks in on the health of the Japanese economy.
Tom, as you know, Japan is heavily reliant on exports to the U.S., and as such, companies in the country have been struggling with the effects of U.S. tariff policy. And judging by the recent record highs for the Japanese equity market, those dark clouds seem to be lifting. For a closer look, I'm joined by Taro Komura. He is Japan economist for Bloomberg Economics, joining from our studios in the Japanese capital. Taro, thank you so much for making time to chat with me. Before we get into some of the details, can you give me a sense of how well the economy is performing, especially in light of the U.S. tariffs?
Of course. Thanks for having me. Actually, the U.S. tariffs, although Japanese government was able to lower it than the threatened rate, particularly lowering the sectoral tariff to the auto, was a big relief for markets. They reduced from 25% to 15%. In general, but still that was a lot higher than previously levied, and obviously the auto sector is a key sector for Japan. But that said, so far the damage is likely to be muted. I think there are several reasons. Of course, the Japanese car makers are experienced in dealing with many jolts, including the trade friction with the United States. They had it back in 1990s and previous Trump administration. Also, another key factor is a weak yen. It's traded around 148, 150 per dollar. And this is far weaker than the surveyed exporters' break-even exchange rate, which is tallied around 130. So there's a buffer for exporters to ship their products to the U.S. and still securing the profits. So therefore, it's a profit hit for many exporters, particularly for automakers. But still, it doesn't necessarily mean that they have to slam the brakes on their production line.
So I'm curious about how fiscal policy may enter the story here, because we had an election recently that created a bit of upheaval. One of the things that people began addressing was this issue of more government spending. Is that likely to be the case, do you think? Will that happen?
Exactly. You need to watch carefully on the developments on Japanese political landscape. And as you mentioned, it's obvious that the government is likely to be more fiscally expansionary. The current Prime Minister Ishiba is known as fiscal restraint, or he cares about fiscal soundness. That said, he lost the election, and even if he stays on, he needs to, I think, expand fiscal stimulus in order to withdraw concession from the opposition parties. And if he steps down, that means further expansionary pressure to fiscal policy, because any potential candidate for next prime minister is likely to be more having affinity for more fiscal expansion than current Ishiba. So therefore, going forward towards the end of the year or the next year, I think the fiscal stimulus is likely to be announced, and that could bolster the domestic demand and probably support the equity prices.
As you well know, inflation in Japan has been well above the BOJ's target for some time now. We have a CPI print in the week ahead. Give me your sense of what's happening on the price side and what may follow when it comes to the next move from the Bank of Japan.
Exactly. So inflation is very hot. If you have an image that Japan is the deflationary country, it's already in the history book. Japan is now in inflation, and I expect the July CPI print will still hover over 3%, headline 3.0, and core CPI remain heated around 3.4%. And the downside risks that it suggests is Japan is probably facing a stagflationary pressure because typical conditions are met. Inflation is surging. The government is likely to be more fiscally expansionary. And the BOJ, it's getting actually taking a more cautious approach towards the next rate hike. I expect the next rate hike is going to happen in October. That said, based on their communication, the Bank of Japan emphasizes they will take a risk management approach. So therefore, before that, the BOJ was just raising rates if they judge the inflation is solid, but they're starting to have telegraphing a signal that even the inflation is picking up. It's going to depend on the situation, and I reckon behind that stance there's a political uncertainty going on. The BOJ doesn't want to make any waves when the government is trying to expand their fiscal stimulus. It doesn't mesh with the BOJ's hiking rates. So I think the BOJ is reading the circumstances and trying to judge when the political situation is conducive for hiking rates. So therefore, my baseline is October, but I think the risk is skewed towards the delayed side. So that means basically the BOJ is turning a little bit dovish. That will add to inflationary pressure. So probably Japan is edging into the situation where the Fed or ECB had experienced a few years ago.
Taro, maybe you can give me a sense of the labor market as well, not just with the employment picture, but also on the wage side. Are things holding up reasonably well right now?
I think wages are also picking up sharply, adding on to inflationary pressure. As you know, Japan is an aging population and the labor shortage is serious. If you come to Japan and come to restaurants, you know how the shortage of staffs are going on. You need to wait many minutes for your plate to come. That means the corporates are very willing to hike rates in order to retain workers or obtain workers. And I think that kind of cycle won't stop as long as Japanese structural labor shortages will be solved. And I don't think that's going to happen in coming few years. So therefore, the recent big movements that the sharp wage raises in Japan will continue, and that will feed into the inflation. And so the BOJ needs to be really cautious.
So having said that, then, how would you characterize the health of the Japanese consumer right now, given everything that we're talking about in terms of employment and wage growth? How are consumers in Japan feeling?
I think you need to think about two types of consumers which are in opposite directions. One is the younger generation. They're enjoying the recent surges in wages because they're going to work longer. The corporates are willing to invest in those young workers. And so therefore, actually their consumption is picking up. And we see in the data for leisure or entertainment-related goods or services are picking up, and also their prices are also picking up, pushed from a demand side. That said, when you think about the older generation, like older than their 50s or 60s pensioners, of course, pensioners are not enjoying the wage rises, and also in Japanese pension system, the pensions they receive by design won't pick up as much as inflation does. So therefore, they are struggling to make their ends meet in their daily lives, particularly the food prices. The rice prices are rising sharper than the general inflation. And also the workers in their 50s or 40s are not enjoying wage raises as much as the younger generation does. So I think there's a dual situation going on. For youth, the consumption is strong, but for older generation, their sentiment is damped by inflation.
Taro, thank you so much for joining us. Taro Komura is senior Japan economist for Bloomberg Economics. So now we have a better understanding of the Japanese consumer. Let's broaden things out a bit. Matthew Driver is the executive vice president for services for the APAC at MasterCard. He's on the line from Sydney. Matthew, thank you so much for making time to chat with me. I know consumers across the Asia Pacific are as varied as the economies themselves. Japan, for example, is dealing with levels of inflation it hasn't seen in decades. Other countries, as we know, are dealing with very, very different dynamics. But I'm hoping you can speak to the overall level of consumer spending that you're seeing across the APAC. What is it right now?
Yeah, sure. Look, I think, and thanks for hosting and having me on the show. Look, despite the macroeconomic uncertainty, consumer spending across APAC remains healthy. I think that's driven by a couple of factors that are important. You've really got low unemployment. You've had a decent amount of real wage growth, and that's really helped, right, to essentially ensure that you've got demand across segments. I think our Economics Institute forecasts steady GDP growth. So what we are seeing is broad-based. The customer is pretty resilient. There's been a little bit of stress in some places as rates have been higher for longer, but you have to think about there are also some longer-term drivers that are going to be quite positive, right? You've seen interest rates are starting to come down, number one. Number two is you've got some easing of fuel prices. That's point number two. And point number three is goods continue to be cheap. China's leaning into the region, and so that's helping on the value side as well.
Do you have a sense of whether U.S. tariff policy has adversely impacted consumer sentiment in the region?
Look, I think that we're really trying to think through the impact of tariffs. I think, look, it's a complicated environment, but look, Asia Pacific continues to navigate that. There are going to be some shaping or some alterations and adjustments. But also, I think, while those dynamics pose some challenges, they also underscore that the region is very resilient and adaptable, right? I think that post-COVID, some of the supply chains have become pretty flexible. That's been very, very important. And while tariffs have raised import costs to a certain degree in more price-sensitive markets, there's been, trying to, I guess, adjust, consumer spending. There's been a little bit of value shifting like we talked about. But what we're really trying to do is make sure that, we're helping our customers navigate that with insights and intelligence. So I think that despite, some of that uncertainty, people are probably putting off some of the longer term transactions, right? They're really focusing on, how do they ensure that they're driving value today, shifting those patterns of spend a little bit. And so with that in mind and the factors I mentioned earlier, we are seeing pretty steady demand, and that's really reflecting the resilience of the consumer overall.
Matthew, thank you so much for making time to chat with me. Matthew Driver is Executive Vice President of Services for the APAC at MasterCard. And I'm Doug Krisner. You can catch us weekdays for the Daybreak Asia podcast. It's available wherever you get your podcast. Tom?
Thank you, Doug. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.
As a contractor, I don't pay for materials I don't use. So why would I pay for stuff I don't need in my mobile plan? That's why the new MyBiz plan from Verizon Business is so perfect. Now I can choose exactly what I want, and I only pay for what I need.
Right now, with MyBiz plan, get our best price, as low as $25 a line. Visit Verizon.com/business to get started today. New lines only. Price per month with 5+ lines. Includes auto pay and paper-free billing and promotional discount. Taxes, fees, economic adjustment charge. Applicable add-ons, prices, and terms apply. Guarantee applies to base monthly rate and stated discounts only. Add-on prices additional. Offers end September 30th, 2025.
Running small and medium-sized businesses is hard work. Business owners need to be sure that their ads are working just as hard as they do. Amazon Streaming TV Ads helps put small and medium businesses front and center on premium content and shows that people are already watching. With Amazon Ads, you don't have to sacrifice relevance for reach. Trillions of browsing, shopping, and streaming insights help you reach the right audience. And measurement tools show you what's working the hardest to help you optimize your campaign in real time. Gain the edge with Amazon Ads.
These days, AI can help you adopt better time management, but it can't stop colleagues booking meetings during lunch. But how about being able to easily adopt industrial AI to streamline your business? Siemens Accelerator helps you find the right AI providers and easily understand what they offer, so you can use modular solutions to quickly scale up and grow your business. That's AI for real, from the global market leader in industrial AI, Siemens. Learn more on usa.siemens.com/AI.